Guys, it's Max Convexity here. I saw this Miami hedge fund week, and there was a panel that Jay was on, and I thought you guys might be interested. This hedge fund week looks cool. They call it the Coachella of Wall Street's Coachella, or Wall Street South. Ja Rule was headlining this year. Peter Thiel was there as well as Kushner. Evidently, they hang out at the Fontainebleau and all the clubs in Miami. It sounds like a really awesome time. I thought, though, that this panel that Jay was on was really interesting. It's about an hour and a half long. I cut it down to just Jay's parts and some of the more interesting stuff, and I thought I'd play it for you guys. You guys might be interested, and I'll react to parts of it. The only news he made that directly affects the funds that are out now is he said that they sell the option for triple QY at 401 every day. So right as soon as the market closes, they sell it the next day. I don't know if that makes it typically a zero DT because it's after the close, just 1 minute. Before, they've always said they sell the option towards the end of the day, and so it left questions as to how much extrinsic they actually captured, because you have to know exactly where the index is at the moment they sell the option to be able to figure the extrinsic. Well, if they sell it right at the close every day, then it's easy to figure out. So this makes them more predictable, and I like that they do it this way. I just haven't heard them say that they sell it at 401 every day. Anyway, so that's good news. Let's listen to this.
Cool. Last but certainly not least, we're going to go down, talk to Jay. So you've been running Zega. You do a handful of different things, and you could kind of take this a couple different ways, but you've been running Zega for like 13 plus years, something like that. You have a handful of products with longer track records. They're longer. They've been in existence much longer. Recently launched, I have to focus a little bit of attention on QQQY, an ETF that does use NASDAQ 100 index options. We like that. So I'd like to know more about your kind of day-to-day grind, and with some emphasis on that newer product.
Yeah, thanks, Kevin. So yeah, the day at Zega really revolves around who our clients are, which are ultimately retail clients, right? So we are a registered investment advisor. Actually, show of hands, how many RIAs in the audience? Like 4? Not many, right? 5? So for us, most of the products that we put out are designed for the retail investor, which means, you could be right for a long time and get fired for being right in the long run, right? It could be a very touchy business. And so the products that we manage, whether it's the newer product, QQQY, or even longer term products, are designed to kind of around options in a way to kind of capture like ever-present trends, right? Some things that we know. Selling time decay is usually a pretty good thing until the day that it's not.
Yep.
Markets generally go up, right? Large cap has been the trade of the decade, so it's a safe thing to be stuck in there. You asked why nobody's talking about the NASDAQ 100. Does anybody want to compare to 50% last year? I don't think so. So most people say the S&P. But generally speaking, right, these longer term trends help you communicate to the end the end investor, which gives you kind of the ability to keep them involved, because philosophically you can give them something to believe in. The longer based strategies that we've run can have a longer term time horizon, 1, 2, 3 years out, based on creating synthetic stock, right? Creating synthetic markets with protection, or even capturing the most rapid time decay of options like the QQQY product. So let's talk about that one for a second, because you brought it up. This is a newly released ETF. We use 0 DTE options in an ETF wrapper. I mean, I guess technically they are, because we put them on at 4:01 p.m. and they go to the next day at 4, right? We're in the market for 24 hours, and we're just harvesting time value, right? We're just selling basically in the money puts, slightly in the money. They have some extrinsic, and it lets us communicate that, hey, we know options will decay over time, and you get the most rapid amount of time decay with 1 day to go for at-the-money options. And so in those scenarios, this fund itself is designed not to beat the equity markets, but to be kind of an alternative income product, right, where we can harvest this time decay each day and then kick it out in the form of a dividend each month. Now, for anybody that follows the volatility markets, right, options are always a reflection of that. Right now we're in a low vol environment, but in the past there's high vol environments. This product is selling on average about 25 basis points of time decay each day. So what that does to a yield, right, times 250 days a year, like the actual time decay we're earning in that fund is like 60+%. So it looks very, very attractive to the retail client. Ultimately, you're capped on the upside, and then the money put is like a covered call strategy where you can only earn so much on the way up, but you have full exposure on the way down. That kind of product is meant to kind of hit a different niche, right? Again, the retail, I think it's pretty much mostly retail at this point that's investing in that kind of a product because they see these, if my compliance guy was here, he would say, don't say this, but they see these nosebleed yields of 40, 50, 60% because that's what that time decay ends up kicking out. And so education is such a big deal for us. I think today, so on the way here, I had 3 calls with investors, right? I was driving down we're in West Palm, driving down, and it just, people need to understand the pluses and minuses of this. So for us, it's not only coming up with those products that, kind of give you the philosophical, long-term, explainable, repeatable characteristics, but then it's also the education around options. Like options always require education, and so it's something that we talk about fairly frequently. It probably takes up 10, 20% of my week just talking to people about how to use these kind of products. Just because it's in a ETF wrapper doesn't mean everybody should buy this kind of a product, right? It means you should know when to use it, how to use it, and what to expect out of it. And
your compliance person likes that part.
I like it too, right? Nobody wants to get that phone call from an investor who goes, explain to me why this thing, goes down once a month by 5%. It's like, that's the next dividend, that's the X date, right? And it's just not seen, right? So these are kind of new products out there that I'm not sure the world is used to yet, but we're doing our best to get people ready for it. So a lot of our day is talking to retail clients, talking to retail investor, and then hopefully advisors will start to incorporate this into their overall mix.
So I feel like what we're doing.
I like how he said there, just because it's in an ETF wrapper doesn't mean everyone should buy it. The being in an ETF does make it just so accessible to everybody, where you can get shares or fractional shares at any brokerage. You can, that is the really good thing about it. And I guess that's kind of what they're concentrating on this panel. So they're talking about the increasing accessibility, and availability of these investments. And Jay was saying he spends 10 or 20% of his time, talking to people, customers, because people are, wondering why the NAV does this and blah, blah, blah. I could see that. I mean, I'm surprised he doesn't spend more of his time, in client meetings explaining how they work, because these are, these investments are fairly complicated. Anyway, I think this is a good video, and I like how he's talking like he's talking to his peers. He's not, these are other guys in the same business, and he's kind of pitching his fund and his idea to them, and I just think it's interesting to hear and to get a different perspective on it. I hope you guys are liking this. Let's listen to a little bit more.
Is starting that evolution. We're going to talk more about that ease of access, because everything you guys are touching on has been, a handful of years ago, would have been inaccessible, at least to my knowledge, to the retail community. And I think that is a huge benefit. Access broadens opportunity. We get, not getting super philosophical, but the education component is critical. Just really quickly, if it is a relatively quick answer, how do you get fired for being right?
Yeah, you could be fired for taking risk off when they asked you to take risk off. And then let's talk about the beginning of last year. Everyone was scared, right? 27 out of 28 economists predicted the recession. But when you stay, okay, we're bullish generally, right, longer term investing, but okay, we'll take off risk for you. And then the year comes by and you're like, great, you made 12%. They go, but the market made 24. We said, but you would have made 5 if we rolled you to treasuries at the beginning of the year, right? That's kind of the challenge you have with kind of a moving target with people that could be handsy with their investments, right? Touching the retail investor can absolutely do that. Harder to communicate a philosophy of, look, long term, you want to be invested, you're 65, you can't handle a 2008 scenario, so we got to hedge you, right? That's what you're solving for, but you're constantly in competition, we all are, with the indexes, including the NASDAQ 100, and they go, well, why didn't I just buy those 7 stocks? And because not everybody knew to buy those 7 stocks, right? Like, I don't know which 7 to pick for next year.
Right, and had you done that in 2022, it would have been a very painful year. Right.
I thought it was funny there how Jay said retail investors are handsy with their investments. I certainly know I am. Oh my gosh! And I know I have friends that are like that too. I thought that was funny. Probably would be better if we just said it and forget it. I bet that's what he thinks anyway.
On the what's accessible that wasn't, or maybe what you see as the risk now that these sort of strategies are accessible. Like what's opening up? What could be the, oh boy, what did we unleash here?
Yeah, I'll take a swing at that if you don't mind. So for options-based products, you're right. The derivatives rule opened up a lot of doors. We launched 20 funds last year. They brought in $2 billion. So when you talk about accessibility on new products that are 100% options-based, that really, I haven't seen that in the past, right? It's kind of opening up new doors. But again, it goes back to the what could be the next? You look at leverage that's starting to come out, right? Inverses and leverage there, and things that happen with NAV erosion. Like all of those things, I think are viable that money managers deal with, right? And manage around. And then when retail investors end up using them, they might not understand all of the ins and outs of a structured product, right? I do think that's one of the pitfalls of all of this. But they are, to me, they're catching fire. We're scheduled to launch another 20 over the next 6 months, all options based again. All of this is around what else can you do now with the new structure that's available that before you'd have to open up an individual account and a money manager would have to manage it. Just one more example. We see advisors and clients all the time that have Apple with a cost basis of 20, right? And a client walks in the door and the advisor goes, I can't really do anything with this, right? Like it's here, I can't sell it, I can't diversify them. So in the past, an options manager then could do things like hedge it, overlay, calls for income, that kind of stuff. Now you could replicate that in an ETF format where we run a covered call strategy on Apple, just Apple, right? So that while it makes the accessibility much easier, there's also, we didn't get to have the conversation that, Apple may get assigned at, 195 next week, right? It's just one of those things that you miss that manage the expectations so that people understand performance.
All right, in this next part, they talk about the presidential elections coming up in the United States and how volatility will be affected right around the time of the election and if they can predict it and all that kind of stuff.
Fair. Any dissent there? Is there any potentially unique opportunities in an election year, whether it is on the volatility front? Do you expect there to be higher vol moving in later in the year, or more of the same?
No, I for sure more vol going into the end of the year, but I agree. It doesn't matter long term who's in the White House, right?
Yeah.
Who controls Congress, but you still need to be able to talk to it, right? It's interesting. 70% of the time on that election year, the markets are up, which is about average, right? So there's nothing particularly, differentiating. Whereas, say, the third year of a presidential cycle is by far the best. We saw that last year, obviously, but I think it's more of an interesting. Again, sorry to pound this, but talking 100% of my client reviews this month have brought up the election. What are we going to see? What are we going to see? And it's your point of, it's okay. It doesn't really matter. Yeah, we'll be watching for this and we'll take advantage of opportunities. But overall, it doesn't matter.
To what extent?
Jay won't take the bait on that political question. He's just like, oh, we'll look for opportunities as they happen, but he's not saying which side he prefers. They don't try to predict something. I think Jay believes in the efficient market hypothesis, and that is that the market is random and unpredictable. And everything that can be known about the market is already priced into the market. That's the whole philosophy of that. And I think it's served him and a lot of other money managers pretty well.
I will finish on one point here. And for me, as a money manager, as a portfolio manager, the greatest compliment we could get is doing what we said you did. Oh, you did what you said you were going to do. The challenge is getting that information out there, right? So it's podcasts, videos, the whole hiring a PR firm anymore to get on, Bloomberg and CNBC. Less impactful these days than it used to be. So just get the message out there. That's all we can say.
Well, that's what we're doing today. We appreciate your making the time. We got time for questions. Yeah.
Yeah, just one quick question. The ETF rule is about 2 years old. You guys are all very sophisticated in your strategies, and I've heard that education is important to each one of your firms to get your products out to the masses. How far into this process do you think we are? Are we're just starting getting out there?
I thought this was interesting when this guy from the audience asked how young this industry is and how much more room they have to grow. I thought it was interesting what they said here.
Educating folks, or is it are we just in inning 2? Because I think there's a lot of room to grow, and that education could be that 20-second video, which seems to be all that people have capacity for, and then the 30-page white paper sometimes. Not everybody's doing it.
Yeah, John, it's early, right? I mean,
if you just think about, there's $10 trillion of actively managed equity mutual funds, and there's $300 billion of actively managed ETFs. We're very, very early. We're very early.
So you guys are the edge.
This is
this is the cream of the crop right here.
Next, someone asked this Bob Elliott, who's the man sitting next to Jay on Jay's right. He's into hedge fund replication. Anyway, they asked him what can they do and what can't they do, and it sounds like it's pretty much wide open.
Yeah, for sure. I mean, just the nature of, if you go to the trade execution side of things, there's a fair amount. You're not going to be able to trade, minute-to-minute tick trades in an ETF wrapper, right? So there's high-frequency trades that are not appropriate for the ETF. You also need to be trading liquid securities, right? So a lot of hedge funds will, I can speak from the hedge fund side, will be trading things that are, taking advantage of illiquidity premiums on particular securities, which are not appropriate for the ETF wrapper. And so, there are things that you can't do, but I mean, just think about it. Whether you're talking about, Jerry's 400 markets, or we're trading 65 of the most liquid markets in the world, that represents the vast majority of assets in the world, the vast majority of exposures in the world, and so the reality is, no, not every strategy, but most of the stuff, the vast majority of strategies can be put into an ETF style wrapper in one form or another.
During this talk, the guys referenced the new derivative rule several times, and this was it was actually a regulation that was passed by the SEC back in October of 2020. But what it did, it opened up the door for these option trading funds, and what it actually allowed is it actually streamlined the requirements to get approved. They used to make it where if an ETF used derivatives like options or futures, it was considered a complex fund, and it went through a different approval process, and it took 10 times as long and something. Anyway, they streamlined it. They no longer considered it complex if you sell covered calls, and it really should be, because it's not all that complex, but so this rule also made it where these firms could enter and reverse repurchase agreements in similar financial transactions. So that's like swaps and stuff. I don't know what unfunded commitments is. Maybe someone can tell me in the comments. I was thinking maybe naked puts, selling a naked put, even though they have the money in the account. It's not yet funded, so I was thinking maybe that was naked options. Naked options that weren't really naked, but anyway. So Also, it allows them to own money markets. I guess before they couldn't do that, and they couldn't invest in securities on a forward settling basis. So anyway, this act opened up the industry, and if you remember, or I remember, I should say, that's 2020 was about the time that JEPQ and JEPI started. And then around 2021, we got some more of them. And then in late 2022, we got even more. Then in 2023, you had, in late 2022, you got Tesla. And then after that, in early 2023, you got OARC. And then about halfway through 2023, you got a bunch of other yield max funds. Then into the fall of 2023, of course, you got, Defiance joined the party with their QQQY and JEPY. And now it's just absolutely, it's just a free-for-all now. You heard Jay say in this video that they were going to have another 20 come online in the next 6 months, all option-based. I mean, I'm really excited about it. I think everyone knows that. I really like this SPY T that got released today, where it's a targeted income fund. I think targeting the income at 20% is basically just going for 1/3 of the income. It has the same effect, in my opinion, as a fund that got all the income and paid it to you, and then you reinvested 2/3 into the fund. You bought the shares back of the fund. That's my rule of thumb to prevent any kind of bad situation with the NAV. To keep your investment the same is to reinvest 2/3, and that should, and as a rule of thumb, and that should do well. And I've shown multiple studies on it and everything. But the targeted income does the same thing. They just sell enough income to make 1/3, so it has the effect of you don't even have to reinvest the 2/3 because they leave the other 2/3 of the fund untouched. It's still free to appreciate because these guys sell a call spread instead of just a naked call. The fund can appreciate over when it gets on top of the strike that is bought if you do have runaway up markets, which we do sometimes. So that's just an example, SPYT. For years, I've heard about hedge funds harvesting the roll yield from VIX. Volatility futures, VIX futures decay naturally. It's a decaying asset. Well, for years, hedge funds have done exactly what SFOL is doing now. SFOL just brought it to the public. Something else they talk about in this video, and somehow I didn't get this clip in the video, but they were, the guys were talking about, this is exactly the same stuff that 3 years ago, just 3 years ago, investors were gladly paying 2 and 20 for. And 2 and 20, if you don't know, and I act like I know, I've never been charged 2 and 20. I've never bought a hedge fund, but I've heard about it. But 2 and 20 means the manager is charging you 2% a year to manage your money, to be in his hedge fund, and then you have to give him 20% of any profits you might have. So, and people gladly pay that. So right now people complain about the 1% expense ratio, and that it is a high expense ratio. 1% is a massive expense ratio, no doubt. But just 3-4 years ago, people to do strategies like we're talking about today, and like I mentioned with that risk on, risk off, and any of these, they have a bunch of inverse funds coming out, and any of these used to just be the, what hedge funds did. You couldn't do them unless you're a hedge fund, and hedge funds, 2 and 20, think about that. That's a lot of money. So, if a hedge fund might make 40% in a year, and you would only get to keep 32% of that. And not to mention, you would pay a 2% expense ratio, so double what we're paying now, plus whatever the fund made, you had to give back 20%. You had to kick 20% of it to the manager. So if it was up 50%, you were only up 40%. Now, it's a great first world problem to have, but they did the same thing to you in years they were up 10%. So in years they were up 10%, you're paying an expense ratio, and you're only up 6%. Like I say, definite first world problems, but it's just a very exciting time to be an investor. And I'm going to cover all of these funds. I'm not just interested in the covered call funds. I'm most interested in those because that's how I've got into this option selling, was through covered calls. But I'm interested in all of them, any of them that use options to somehow enhance the return or something in any way. Something else they were talking about that I'm really excited about at this conference is return stacking. And that's where you use leverage. And they gave an example. So with these new rules, they'll have funds soon where they can replicate a 60-40 portfolio, 60% stock, 40% bonds. But they put 1.5 times leverage to it. So you can spend 70% of your money on one of these 60-40 funds, and you will have the same effect because of the leverage. According to this sales pitch, I fell for it. I haven't checked into any of this yet, so but according to this, you can do this with 70% of your money, and you'll have synthetically you'll have the same exposure as you would to a 60-40 portfolio. Like I say, you can do it with less money now, so that frees up money for these alternative investments. That would be a perfect place to put some of these funds, the covered call funds, the daily covered call one, the SPY-T is, I think it's really interesting because of the way they leave the upside open. There's a jillion ways to leave the upside open. These guys at SPY-T don't have the only way to do it. You could also do it like XYLG, where they just overwrite half of the portfolio. I believe Bally and GPIQ and the Goldman one, they also don't overwrite the whole portfolio. They have an algorithm or a method where they overwrite a third to a half of the portfolio depending on the conditions, and they can overwrite more of it. So you can do something like that, and that helps control the NAV slippage problem. You can also do what these guys at SPY-T did, where they don't sell as expensive instead of just selling a naked option and trying to bring in the max yield, like the other funds like Yield Max and Defiance do. They sell a call spread, and they bring in a third of the income. Well, so you, instead of making 60%, you just make 20%, but you have your upside is uncapped. It is partly uncapped. So it's a very exciting time to be an investor. There is no doubt. So I'm going to be following all of these, and I want to thank my good friend Tiger. His channel is called Tiger on Fire. He has a YouTube channel, but he's just an all-around good guy, and he's a spreadsheet expert. All my friends are spreadsheet experts. I also have Corey's a friend, and she's a spreadsheet expert, and so's Havoc. There's another person in Discord called Havoc. Then there's another one called Brian, and they all have spreadsheets, and they're all awesome, and I'm learning a lot from all of these guys. But so whenever a new fund comes out, I'm going to put it on here, and we're going to follow it, even if it's one that I'm not particularly interested in. Like, let me think of an example. No, I don't know, like Devo. There's nothing wrong with Devo, but now that Tiger made this spreadsheet for me, I can keep track of everything. We can look at Devo, and I can tell you what dividend it paid what month. I can tell you what the total return was in 2023 or 2024. I can tell you what the dividends were in one of those years or the average dividends. This takes Max's, high yield math, which is the NAV change. Well, the NAV return plus the dividend return equals the total return. And Tiger took that and he put it right here in a column so you can see everything. Like look at FEPI. FEPI, its NAV is up $4.19 from where it started. Okay. So that equates to a NAV return of 8%. Well, its dividends return is 9% over whatever time period. I think that's over this year. So anyway, then 8 plus 9% is the total return, 17%. And I bet you that's just the return for this year. But then he also breaks it out to 2023 return for the funds that go back further. A lot of these funds started in 2023, but a few of them started in 2022 too. So anyway, this is just the most excellent resource. I'm going to make a video comparing all of these funds to each other since inception, and this is going to be central in my video. But I'm going to use this on a daily basis. So shoot me a message in Discord if there's something I need to put in here or anything we're talking about. I'll be putting in here. Even, like I say, even ones that I may not be watching all the time. And Tiger's been awesome. He's you can put the fund in and it auto-populates the price and stuff, okay? But you have to put in the start date of the fund and you have to go put in the dividend amounts. And I was doing a few of these, but I got busy and then I came back and then he just mowed through all of them. I mean, he did a bunch of these. This spreadsheet's like a work in progress. He works on it where he's at on the West Coast and I work on it here. Anyway, I'd really like to thank Tiger. It is an awesome spreadsheet and I cannot even think of the years of good videos that this spreadsheet will spawn. All right, guys. Well, I hope you like this video. I hope you have a good weekend. I'll be back with some more videos this weekend. You guys have a great evening.